Welcome to Share Talk, the only podcast where investors come first.
Hi, this is Zachmir with the Bulletin Board Heroes on Tuesday, the 10th of March, sponsored by the UK Investor Show here on Share Talk. You might have spotted that there was no Bulletin Board Hero slot yesterday, or more Bulletin Board Zeros rather than Heroes yesterday, so it seemed sensible to avoid the panic and the carnage. Just had a request regarding the FTSE 100 just to get off, to start off with. Here you can see that basically we've hit this line of support, rather weird line of support there from the middle of 2017, running just below the 6,000 level. That was, I think I tweeted out the sort of target area that we had. If we broke 6.5, which looked unlikely, then 6,000 would be the hopefully the final resting place on this particular sell-off. Obviously, remember that 20 years ago, more than 20 years ago, the FTSE peaked around 7,000. So we've really done, apart from dividends, we haven't actually achieved very much at all over the last couple of decades. The point to note, I suppose, here really, though, is the RSI as of last night at 18 out of 100. That's really, really oversold, and you don't see that very often. You see that once every few years. So we had an equivalent level, I suppose, in the aftermath of the well, actually, no, that was before the Brexit vote, running the run up to that. So that was a very oversold point. And then after that, the market rallied, 800 points. Other bounces that we've had have been from higher RSIs. So it'll be interesting to see whether this is a dead cat bounce, say we go back towards 6,500 and then come back down again towards the 5,500 zone, or this is it. At the moment, probably one would favour this is it, especially given the way that we've had now two strong sell-offs. Maybe there'll be one final one, but only after a rally from very oversold areas. As far as the normal fare for the Bulletin Board Heroes are concerned, the stocks today start off with Avacta. Here you can see that we have a stock which was relatively untroubled by the turmoil of the last couple of weeks. The shares near the lows, I suppose they bounced off the lows near 15 very nicely and gapped up today through both the 50 and 200-day moving averages. That's just around the 22 pence area. If you want some more evidence of the stock's credentials, probably want to see an end-of-day close above that February resistance line at 25 pence before penciling in a top of July trend channel target as high as 45 pence. Obviously, in the meantime, you've got 30 to 35 as the resistance area. Only back below 20 pence, and that gap left from the end of January really kills the idea of an extended run here for the shares. Very active looking chart coming up next. e-Therapeutics, ETX is the ticker code. Covered this before when it broke that line of resistance from September around 4.5 pence. The shares then peaked at 8 pence, hitting that line from February last year. And that's one of the reasons I draw these lines, so that you have an idea where the potential upside could be. Current situation is we've gapped through 6 pence, so above 6 pence, looking for 8.5 on this particular run, and possibly much more. Could be the case that the shares actually are aiming now for a line of resistance from as far back as September 2018, and that could be hit up to 13 pence. So above 6 pence, everything to play for on the upside. Only back below the 50-day average at 4.47 pence, really killing the idea of ongoing recovery for the shares. Katoro Gold, one of the Bulletin Board and Twitter RT favourites. Here we have a situation where, not surprisingly, there's been a lot of consolidation since peaking out near 5 pence last month. Yesterday's sell-off just took the shares to hit the 50-day moving average at 1.92, giving us a very good end-of-day close stop loss. But if you're cautious on the shares, maybe you want to see 2.4 broken, the February resistance line, on an end-of-day or end-of-week close basis before targeting 5 pence or the 5 pence area once again. New stock to this particular video is Litigation Capital. Here you see a very solid looking candle after a bear trap below 50 pence, which was just yesterday's, thanks to yesterday's price action, just a temporary bear trap. Need to close above, I suppose, 60 pence and that January resistance line. Depends exactly where you draw it. Actually, I suppose 60 pence is the level though, and above 60 pence we could actually head up to the 200-day moving average area as high as 80 pence over the next few weeks. Stop loss at this stage probably back below 55 pence, basically half the rally that we've seen so far today should do the trick. On to a relatively obscure stock, but one which seems to be making some moves at the moment, and it comes in the form of Osirium Technologies. We've gapped bear trap gap reversal. Got a line of resistance there from February running through 20 pence, and a while above that looking for 30 pence. We obviously had a full storm. Well, it wasn't actually a full storm. We actually spiked up after that triangle break towards 30 pence, but then new lows set in. Second time lucky, hopefully, for the shares after the gap today, heading for 30, and then the best case scenario target up towards 45 or even 50 pence, which is a line of resistance from September last year. That would map out a broadening triangle formation. Many of the best recoveries come out of that kind of formation. Next situation is Panther Metals, where I'm trying to jump the gun on the long side, largely because there are so few bullish situations, fresh bullish situations at the moment. The old low there in February, 3 pence, and we had a one-day bear trap below it, and looks like we're going to close above 3 pence. So above 3 pence, we got a bear trap signal there. If you're cautious on the shares, maybe wait for 3.2 or 3.3 pence above that line of resistance from February, but aggressive traders probably going long now with a stop loss back below the intraday low of yesterday at 2.7 pence. Next up is another stock which hopefully is just delivering some technical green shoots. Here we've got a falling wedge for Physiomics with the line of resistance there from December at 2.45 pence. End of day close above that could take the shares up towards 3 to 3.5 pence. Stop loss back below that old low. I suppose 2.2, 2.1 pence would do the trick at this stage. Finishing off with what might be argued to be the best of the day in terms of prospective situations. Comes in the form of XLMedia. Not much to look at perhaps initially, but you can see that the shares have broken this falling wedge, or at least on an intraday basis, at 21 pence or 22 pence, let's say, so far today. But the main highlight here, apart from the bear trap reversal from below 20 pence, is the bullish divergence in the RSI window. That should propel the stock towards 30 or even 33 pence, which is the 50-day moving average. That's it from me today. More updates.
Thank you for listening. Remember to visit our website for more news and other podcasts at www.share-talk.com.